Okay, Bismillah ar-Rahman ar-Rahim. Just to put all things together, this is a chapter about the financial planning and market efficiency. Okay? And to remind you about the financial planning, the first step in the financial planning is setting goals. After setting goals and the investors introduce their environments, particularly their individual environments, their age, their family status, their economic situation, and other things related to the individual criteria, then we go to the asset allocation. In the asset allocation, we decide in which classes we invest our money. For instance, we invest on the equity or in bonds. If we decide in equity, in which equity? In common stocks or in the preferred stocks. If you decide in the common stocks, in which common stocks? In the technology, in the industrial, in the foods industries, pharmaceutical, and you have many or a variety of options to go through the investment. And during our journey in setting our investments, we should consider the importance of taxation, because taxation has a direct impact on our investment decision. Through the taxation, we can avoid taxation, we can reduce tax, we can defer tax. And we know how we can use the taxation regulation in order to reduce tax or to defer tax or to avoid tax, which is very important for investors to consider the taxation brackets or the taxation rate. Today I'm going to link between the process of investment and the market efficiency. The link between them is important. And there is a tiny relationship or a tiny difference between the efficient markets and inefficient markets relative to the investment process or relative to the financial planning. If the market is efficient, so investors can easily asset their allocations or allocate their assets. If the market is not efficient, the investors are hardly to allocate their assets. So this is the important link between the inefficient markets and efficient markets. In the inefficient market, it is hard to allocate the assets. But in the efficient market, it's easily to allocate the assets. The question is why? In the efficient market, it's easily to allocate the assets, and in the inefficient market, it's hard to allocate the assets. As we explained before, and in the financial management courses, if the assets are efficiently allocated in the S&L, security market line, so the risk and return are adequately reflected in the security market line. It means if we asking higher return, we have to hold higher risk. But this is inefficient market. But if we are in inefficient markets, we have mispricing. So this stock or this investment is not reflecting the accurate relationship between the risk and return. For instance, these assets should be not in this place, should be in this place. And this asset should not be in this place, should be in this place. These two assets are mispriced. If the investors want to combine a portfolio and they confront like these two assets, they are misleading their portfolios. They include or involve in their portfolios mispriced assets. So the importance of the efficient market hypothesis is to help the investors to manage their portfolios. Okay? So this is the introduction of the importance of the efficient markets. So be careful when you are taking or you are decide to invest your money in which market you are going to invest. Because if you are in efficient markets, it's hardly to form your portfolio. If you are in the efficient markets, it's easily and it's less cost to invest in the efficient markets. What is the efficient market then? There are many explanations about the efficient markets. The important explanation in the efficient markets means that the investors cannot outperform the markets. In other words, you cannot get abnormal rate of return. You cannot, under any other condition, investors cannot get abnormal return. They could get abnormal return one time and they cannot repeat it again. Okay? As I explained when the people fishing, they can do the fish, a big fish, but they cannot do it more than one time. And the importance of the efficient market hypothesis is the link between the return and the risk. The return commensurates the risk. It means included the risk. If the return failed to include the risk, it means we are not in the efficient markets. And one more thing about the efficient markets, no one can beat the markets. The market's power outperforms any investors in the market. So no one claims that he or she can outperform or beat the markets. If the investors have superior information, private information, they no longer use this information in the efficient markets. They can get the normal return. But we could find some people with the superior information. And this information is spreaded with the same style of investors. For instance, if we have one insider have this information, it doesn't mean this information is particular for this guy. It could be spreaded to the other people and they can use it. If the people are lucky, and this is the important, they can expect the event before it occurs. So this is the challenge. And these people, this kind of people, they can outperform the market. But if the event or the news is disseminated in the market, all of people have the same position in terms of the private information. So the idea in here is not related to the private information, it's related to the person. If he has that knowledge and experience and he sees things behind the private information, this guy, he or she may outperform the market. It means the intelligent people, the smart people, they can do this, even in the efficient markets. Okay, this is not violate the market efficiency because not all people are smart. So we just may have 1%. They can see things behind the private information. So the private information not itself make the price to change. Okay? And we will explain this point from the efficient market point of view. In the efficient market, we should consider the importance of risk. As I explained, and risk includes the systematic risk and unsystematic risk. In the next chapter, we will introduce the main difference of the systematic and unsystematic risk and how this total risk influence on the stock return or the market return. Okay? Any question? Okay. There are many assumptions of the efficient market hypothesis. The first assumption, there are large number of competing participants in the security markets. Information is readily available and virtually costless to obtain, and transaction costs are small. Let's go through these assumptions. There are a large number of competing participants. In the financial market, we have countless number of investors. We have informed investors and we have uninformed investors. We have institutional investors like mutual funds, like insurance companies, like big banks, like virtual capital, like governments. So we have a countless number of institutions as well. And these institutions, they spend money and time in locating the information and do analysis about a particular stock. The more interesting or the more focus by the institutions on the financial market or in the particular stock make the stock efficient. This is the important, more scrutinized by institutions that are competing to know the intrinsic value of the stock. The intrinsic value. The intrinsic value means the true value of the stock. So the more people focusing on a particular stock make the stock efficient. And it means the more people focus on a particular, for instance, a particular X or a particular company or a particular bonds, make the bonds to be efficient. It's under the analysis of the huge number of competing institutions. And the more this means, if we have more institutions in the business, it means that the market is efficient or close to be efficient. If you do analysis for the emerging countries or the emerging markets, we will observe the market is less efficient than the developed countries, because the rule of institutions is less than the rule of institutions in the developed countries. The institutions, they have their techniques, they have their employees, they have the investment in how to do analysis on the particular stock. The second, information is readily available and virtually costless to obtain. The information should be available to all of the investors and to all of the stakeholders. And if it's available to all of the stakeholders, this information should be reflected in the price. But if we have investors with a particular information that others don't have, it means the market will not be efficient. Okay? If we talk about the information, we have three different types of information. We have the historical information, and we have historical information, we have fundamental information, and we have a private information. So we have three types of information. The historical information is related to the previous event of the company or the historical price list of a particular stock or a particular bond. The idea of the historical price is some investors going back and bring the price, the historical price of a particular stock, and they do the analysis, and they think if they do analysis, they understand the behavior of the stock, and they reflect this understanding and take the investment decision, which is totally wrong. In the efficient markets, if the market is efficient, then you are no longer use the historical price, because the price reflects the historical things, and because the price is a random walk. Random walk. We will explain what it means, random walk. Okay? And for the fundamental information is related to the economic situation of a particular business. For instance, the financial statement, including the balance sheet, the income statement, the cash flow statement, the uses and sources of funds, okay, and the competitors of the company, the all factors, the fundamental factors that impact on the cash flow of the business. Okay, this is a very important. So the cash flow is as an indicator for the fundamental changes in the of a particular stock or a particular company. So people, they try to have these factors and to see how these factors influence on the cash flow. And based on this analysis, they decide to buy or to sell. And again, if you are using this, it means you no longer get benefit from the financial market. But the exception is for the people, they have a particular experience, they are intelligent, they can predict things before it occurs. Just we put the exceptions, because till the time we still have people outperform the market. Okay? Not because the market is not efficient, because the superiority of the human being. Okay? So this is the idea. Then the last is the private information. This private information is available to the insiders. The insiders, including the people inside the business, like the board of directors, okay, and the people who have access to a particular information about the company. For instance, the Security Exchange Committee, which is the highest rank in the financial markets, and the dealers, the specialist dealers, they know what exactly the number of inflow orders and outflow orders. It means the volume of the trades, the buying and the selling volume, which is not available to others. It means the private information is related to the company, related to the business, and private information related to the trades. It's like when you know the volume of buying and selling things, you determine the price will go up or the price will go down. So this is the private information. And in the efficient markets, we consider that the availability of the private information, and this availability cannot violate the efficient market hypothesis. Again, because the market is smart and can predict the private information. Okay? And again, we are at these things, the price is a change according to the fundamentals. When we talk about the random walk, we consider that the price it changes according to the fundamentals in the long-term run. But in the short-term run, it reflects the behavior of people. And the people who documents that in the short run, the market is influenced by the behavioral finance, they won the Nobel Prize, including Schiller. Okay? 3 people in 2013, they won the Nobel Prize because of this issue. This issue claimed that people keep thinking that the price, and even this book, till the moment, I don't find a particular text that mentioned the behavioral finance influence on the stock price, because this is brand new things in the financial market. And because you are in the investment class, I should tell you that the other factors, a part of the fundamentals, influence on the stock price. And the 2 people who claim that the market is, or the price is a change because of the fundamentals. This is the first argument. And the second argument, they say the price is influenced by the people, which is counter the first argument. Both of people won the Nobel Prize. The first one won the Nobel Prize in 1968, who talk about the fundamental impact on the price of the price. Sharp. And then in 2013, Schiller and Eugene Fama and Russell, they introduce new things to the market. They're saying, yes, the market is efficient and the price is influenced by the fundamentals, but this is in long run. But in the short run, there is a space that individuals, the feelings of the people influence on the price. So that if the people are optimistic, then the price will go up, which is a part of the fundamentals. Okay? So this is their contribution in the financial markets. Again, the fundamental is important. As I said, the changes in the price is driving by the fundamentals. What are these fundamentals? It means the economic situation of the business, like the cash flow of the business, the sales, the dividends, the interest rates. All of these factors considered as a fundamental factors. Okay, so this is the importance of the information that influence on the stock price. The most important one is the fundamental. Because the fundamental, again, influence on the long run of the stock price. If there's a change in the fundamental of the business, or the fundamental anomalies or variables of the business, we should observe a change in the long run of the business. If the business do expansion, we should expect that the price of the business will increase, or the return of the business will increase. If the sales of the business keep diminishing, it means this is an indicator that the stock price or the return will go down. So the majority of the investors are focusing on the fundamental. And this is why the most of studies, the empirical studies, found evidence that the majority of financial markets are semi-strong markets, because the majority of them focus on the fundamental. Okay, any question? The transaction costs are small. In the efficient markets, because we have financial institutions, we have insurance companies, mutual funds, portfolio managers. So the bid-ask spread, or the margin, or the spread, is low. It's very narrow, just to motivate investors to trade. This is for the institutional investors. However, in terms of individuals pay more cost. Okay, because they are not get the advantages of economies of scale or economic of scale. This is the importance. The institutional investors, they trade in a large volume of securities. However, the individuals, they are just trade in the limited number of securities. But still, in the efficient markets, the bid-ask spread is compared to the other financial market is still small. So investors, they can trade in this market. Now, random walk. Okay, what it means, random walk? Yes, you too. What it means? What it means, random walk. So why you are talking together? So please focus. Okay? Random walk. In efficient market hypothesis argues that a security price adjusts rapidly to new information, okay, and must reflect all known information. And I explain what it means, all known information, and must reflect all known information concerning the firm. Therefore, price follow a random walk. Let's explain we know what it means in new information. It's a new information about the business, and we mean in new information, in new fundamental information, not any new information. I mean here is about fundamental information. Yes, fundamental. For instance, the company decide to pay dividends, to take big loans, to open a new branch, to launch a new product, to emerge with others. Or we have many fundamental, to stock split, for instance, to split their stocks. We have many fundamental examples for the new information. The idea of the new information is not predictable. Be careful. We know that the price is unpredictable, but the question is why? Because of the new information. Yes, but this new information is not predictable. No one can predict about this new information. Even the insiders, they don't know. And if they know, they cannot get benefits from this information. Because the financial regulations, the financial market regulation assigned by SEC, Security Exchange Committee, has limited the power of the insiders. They set a particular regulations, prevent them to trade based on the private information. Okay, so the information is not predictable. Information is not predictable. No one can predict the information. And because of the information not predictable, the price is not predictable. So again, the price is moving because of the information. But if the information is not predictable, the price will be not predictable. But if the information is predictable, the price will be predictable. So if the information is predictable, so we no longer having an efficient market. You just do the analysis to the information, and you get the advantages of this information. Okay. It doesn't mean that no one can know the new information. Still, we have some people can predict this new information. Not because they have a particular access to the new information, but they have a particular
conceptual skills.
Yeah, they have conceptual skills which is not available to others. It could be one of the million. Again, because of the superiority of the human being or the human nature.
Yes. And
okay, people can see things that others cannot see. From the information, you can predict many things. So the idea here is the people can outperform the markets. The people, they can predict the information before it occurs. They can understand from the action of the business that this information has a particular information and should be reflected in the in the market. In the efficient markets, and according to the random walk, be attention here, because this is very important, and this is not adequately explained in this textbook. Okay, so be attention with me here. If this is the day of event, what it means, the day of events, launching a new information. So we consider this is the event. The spokesman of a particular company want to tell people about particular things on the company, about the company. No one knows what is inside his report. So he's sitting and telling people, and people receiving things at once. Okay? Maybe one of you asking, okay, he knows what is inside the report. And the board of directors know what is inside the report. I said, yes, they know, but they don't have rights to trade based on this information. In the past, when we have, let's see, less regulations in the financial market, people can use this information. But now and today, there are tough regulations about on the board of directors. Even the guy, he is telling people what is the information. He has no right to trade in his name, and if he wants to trade in his name, he has to tell the SEC, I'm going to trade, and the SEC are asking him to justify why he wants to trade. It's not just to trade in the base of trading, because we want to protect the investors from the people who has the private information. Okay? It's very organized financial market. Then this is the date of events, 0. In this day, the information about the performance of the company, maybe to declare the ABS increase, for instance, or we emerge with the other company, or we will pay out a particular dividends, or anything, or we want to launch S7, if we talk about the Samsung, or if you talk about the Apple, we want to launch i8, for instance. This is a new information which is not available to any other insiders or any other outsider of the business. And even people inside, they don't know what is the launching time of the new product. Okay, the guy is standing and telling people now, the price is fluctuated. Let's see. The price is fluctuated. During the time of event, when he is telling people about this, if it is a good news, then the price will jump like this. You see? The price accidentally, or let's say on time, jump to the top. Because if the people know about the information, they take actions before the event.
Yes.
I will show you how things going. This is in the efficient markets. When he's launching this speech, okay, on the time of the speech, in the first word he is saying, okay, congratulations, the Apple launching a new i7. So in this time, the price jumped. But if some people knows that the Apple will launch i7 in this time, so what's happened for the price? Okay, we are facing the inefficient market and inefficient company. Okay, so what's going for the price? Look at here. If the market is less efficient, let's consider this. Okay, this is the previous one, and this is the previous one. Let's use the blue one, with if some people knows or knew about this information. Okay, so okay. Look at here. There is a jump. Here we have a jump. But in here, because of the leak, the price is starting to go up before the event, not after the event. Yes, because some people, they have knowledge or acknowledged by a particular people from the insiders or from the inside of the business that the company will launch i7. And they took the action. Okay, let's to zoom out this picture, just to see and to observe the difference. Okay, so this is the event. Okay, this is the event 0. The price is in here. The price is leaking in this time. Okay, this is in blue. It's leaked. There's a leak here. Leak. You know what it means, leak? Leakage of the information. It means the information is leaked to somebody outside the business. Okay? And the price is continuous in this. Now, let's see the investors. The people who knows or who knew about the events before it occurs, they have a particular access to private information, and they took action based on this. Now, we have informed investors, people with the private information, they already took the action. Now let's talk about uninformed investors. During the speech, okay, the man is saying, okay, congratulations everybody, the Apple decided to launch i7. So what you are going to do in this case to buy as a normal guy. So you will buy the stock of Apple. Okay? If you buy at this time, you are not get benefit from this trade because the price already reflected the private information. Okay? Because the price is already leaked in the markets. And sometimes what's happened in the markets, the price is going like this. Why? Because the informed people, because they know, they buy more than what they want. They buy. And when these people like us here, uninformed, they want to buy, so these people sell them. And because the attitude of selling is greater than the attitude of buying, the price will drop down. Okay? The price will drop. And some people ask me, oh, there is a good news about the Apple, and the prices drop. How? The market is idiot. No, the market is not idiot. You are idiot. This is the idea in the market. There's a leak of information before the events, and this makes the market inefficient. But if you look at the case where the market is efficient, even these people don't know, the prices jump. Who make the price to jump?
The information.
Yes, the information. Okay, the information. Okay, which institutions do this? The dealer. Because the dealer now, when they're launching, he or she expects that more buyers than sellers, so he make the price up. Not because of the trade, because he expects the trade will increase. So the price jump to the top. This is if the market is completely efficient. Okay? And we don't have 100% the market is completely efficient. Let's go back to the concept of random walk. To introduce random walk on this. I said there are some smart people. They can predict. Okay? Can predict the markets. I'm not talking about the leak. I'm not talking about the leak. I'm talking about some people, they have a particular understanding, or they can predict the markets. These people, they get benefits from this unique understanding. And sometimes if the market is launching new events, nobody knows where is the price. You know why? Because each one has his or her unique understanding about the performance of the company, which is different. I understand, or I may say, okay, the price will go down, others say the price will go up. Even you are receiving the same information, but still you have different understanding. And because of the different understanding of this new information, we tell the price will jump. But this is if the price is completely efficient. But if still we have incompleteness of the price will follow a random walk. Nobody knows. Okay? In this case, when the price jumps because of the fundamental. But when this follow a random walk during the event time, yes, it's fluctuated, but again, fluctuated to reflect the fundamental. I don't want to go in details about these things because it is complicated and it is above your head. Okay? Okay, any question? Any question? Now, we will talk about the forms of efficient markets. You can look at this in this slide. You can look at this. Look at the price. This is on the event of the bad news. Look at the price. It dropped. But if there is smart people in the market, or if the market is leaked, then the price is gradually go down. Look at here in this. It's just the price is suddenly dropped down. But for the other things, on the presence of people, smart people, or in the presence of the leakage in the market, it gradually is like what I explained when it's gradually because of the presence of the unique things. The people who having private information also are smart. Sometimes they have techniques to make their hands invisible. Okay, so it's not just easily buy and sell. Okay, they follow some techniques. I'm not going to tell you about these techniques because it is unethics. Okay. Yeah, you don't need to know about bad things. You should know about good things. Okay. So a random walk essentially means that the price changes are unpredictable and the terms formed are accidental. We don't know. And because the information is unpredictable, the price is unpredictable. The price is determined by fundamentals, which includes earnings, interest rates, dividends policy, and the economic environment of the business. The changes in these variables, or fundamentals, are quickly reflected in a security's price. Okay? So please read it carefully. Read it, expand your reading on this. The speed of price adjustments. Now, because of the availability of the telecommunication, you can tell. During his speech, the price changed. Okay, I had a lovely story about, I think, BMW, or I forget the name of the company. This is last year.
The airplane.
Yes, and you remember their name.
Yeah.
Which company?
لا.
Yes. The manager, or the big manager, he tried by himself a new product. It's like a sport flight. Okay, sport flight. And during his trip, the gearbox is not working. He sent signal to the ground that I cannot landing. During this time, the price of this company go down because of the speed of price adjustment. The journalists are starting to have their cameras, setting their cameras, and observing how this man manage himself. And suddenly the gearbox is start working. And he sent signal again, it's fine, now it's working. And the price is going back. This is a real example about how the technology, the communication system, the journalists make the price to adjust it to adjust information very rapidly. If we don't have that communication, it takes time to, and it may not influence on the price because the story is gone. Okay, and even maybe if we don't have that very fast technology, maybe people have different explanation. Okay, the manager died. The manager, but because of the availability of this type of communication, then the price is a speed rapidly. For securities to be market efficient, prices must adjust rapidly. And we have Google example here. I give you the other examples. You can go back to the Google and see what's happened in the Google. The price go up when they disseminate a particular news, then it go down when they have different news. This leads us to talk about the forms of efficient market hypotheses. We have weak form, semi-strong form, and strong form. Okay? The weak form. We will link between the three types of information with the different forms of the markets. Look at this. We have a private information, fundamental information, and historical information. In the historical information, we have weak markets. Fundamental, we have semi-strong markets, and in the private, we have strong markets. Okay. In the historical markets, it's weak because already reflect the historical price. But people mistakenly understand the weak markets. The weak markets reflect the historical prices. So it means you cannot use the historical prices to predict the price, because the price already reflected the historical price.
Yes.
Or the historical information. So what it means if you using fundamental information, then you can outperform this market. Okay? I will do it in this way. Outperform the market by using fundamental. Okay? Now, in this historical information, people use charts. Charts, or they call them chartists. They use technical analysis. And the charts is important. is giving you indicators, yes. But if you are using a chart, other people using a chart. So all of people can use a chart and get benefit from it. And because majority of people using a chart, so the importance of the chart is vanished. So this is the idea. Yes, you can use the chart, fine. But if only you use the chart, you get benefit from the chart. But because the majority of investors using a particular chart, like moving average or candles or other things or bar chart, you no longer get benefits. If all people eating the cake, it's not superior then. Because all of people eating this cake. Okay, using this chart. But because of people in the weak market using the historical price and thinking that the historical price has a particular impact on the stock price, they no longer get benefit from this. Smart people using the fundamental information in the weak markets. So if you are using fundamental information in the weak markets, you outperform the markets. Because the weak market is not reflects the fundamentals. Okay, let's go to the fundamental or the semi-strong market. In the semi-strong market, the market reflects two things. Reflect the fundamental information and historical information. So it means to outperform the market, you should have private information. Yes. Private information. So if you have private information, yes, you can outperform the markets. But if you still have the historical price and the fundamental of the fundamental information, it's fine. You are like others. Because again, in this market, most of the investors using the same cake. So if you are using the same cake, it means you are not paying extra or you are not get extra return or abnormal return. Just give you example. Now we have many shops around. We have prestigious shop and we have lower prestigious shop. In this prestigious shop, after a period of time, the importance of this become vanished because the ordinary people go to this place. So the other people think, oh, we will provide other services to make it as unique as the people.
Yes.
Okay? The last one is no. We cannot outperform the markets. But in all cases, the smart people do this. Smart. With a unique understanding. They have, let's see, yeah, they see things behind the private information and behind the historical and the fundamentals. Okay? Any question? Any question? A lot of questions in your exam about this. Yes. So be careful, read it carefully. Now, we will talk about, this is week. The last thing in this chapter, I will talk about the empirical evidence for the efficient market hypothesis. I test the Palestine Stock Exchange, and I found the Palestine Stock Exchange is weak. I test the London Stock Exchange, and I found the London Stock Exchange is semi-strong, or is semi-strong in the short run and strong in the long run, which according to the assumptions of Schiller. That in short run, the market is not efficient. In the long run, the market is efficient. When I tell in the short run, I'm not saying short run is months or days. I mean seconds, maybe 5 minutes. You know this? The price is not efficient for 5 minutes. This is the short run. So don't think the market is not efficient for 1 year. And this is related to the price discovery. And this is a new science or a new trend in finance. To know the price discovery is related, it's a particular, it's like physics, how to expect the price. Okay, now, I explained and I said the markets should be efficient. However, we don't have 100% results about the availability of the efficient markets. The markets, or in the developed countries, including United States and UK, the market is close to be efficient. It is not semi-strong, and it is not strong. It's close to be strong. If you have like this distance, here is the strong, here is the semi-strong, and here is the weak. Is located in this area. Is close to be strong. Because we have some violation of the market efficiency. And these violations, consider them as anomalies. Okay? These anomalies violate the presence of the financial efficiency. Okay, we will talk about these anomalies that make the price not completely efficient. Is it close to be completely efficient? Or could be semi-strong or weak. I'm not going to talk about in details. Just I need you to understand about the importance of these anomalies. While the evidence generally supports the semi-strong form of the efficient market hypothesis, there are exceptions. Two of the most important anomalies are the PE effects and small firm effects. I told you, I think, in chapter 1 or in financial management, what means PE. The PE, it is an indicator about fundamental. The price divided by earning per share. Price divided by EBS. The lower the PE, the higher the return. Okay? So if you do analysis for a particular PE, for a particular company, and you're having a lower PE, you expect a higher return. And if you have a higher PE, you have a lower return. Okay? The small firm effect. Okay, you have one question. What do you think? Having higher return, the smaller firms or the larger firms?
Higher return?
No, the smaller firms. Yes. The smaller firms having higher return than the larger firms. Okay?
But for a short period, maybe?
No, it's for long. It's in fundamental. In the long run. The second question. Okay, we talk neglected firms. Neglected firms is like the small firms. What it means, neglected firms? Neglected firms, the firms are not known by the big investors or by the media or by the journalists or by the institutional investors. Not scrutinized or not focused by the institutions. It's neglected firms. Having higher or lower rate of return. What do you think? Higher. Yeah, because higher. You measure or you scale it by the small firms. Yes, higher rate of return. Okay? January effect. January effects. January effects, it means, it's starting our journey to the next year. So people starting buying rather selling. So they are selling in December and buying in January. Why? To avoid tax or to avoid paying high tax. So they're starting January by buying. In this case, the return will be high or higher than in December. So in December, avoid to buy stocks. So buy stocks in January. Okay? According to the efficient market, it should be no difference between December and January. But because of the investors' attitudes, we find it. Okay, there's the impact of weekends. What do you think about weekends? If in Friday, which you prefer, to buy or to sell in Friday? To buy or to sell in Friday? To sell, yes, because people want to relax in their weekends. And in Monday, to buy. So there is a Monday effect then. So in the Monday effect, it means we should observe higher rate of return relative to the Friday. And again, it should be no difference between Friday and Monday because of the market is efficient. But because of the presence of the difference between Monday and the Fridays, the market is not efficient. Yes, we explained the day of the week effect, the neglected firms, the overreaction effects. Overreaction effect is related to the bad news and the good news. I have a little question to you. If you baked a delicious cake in your house, did your neighbor know about this?
By smell.
Okay. Another question. If you're having burnt cake,
Yes,
all of the neighbors know you burned your cake.
Yes.
Okay? So you are trying to hide this. Oh, nothing. Everything is fine. But what we predict that the bad news disseminated in the community faster than the good news. So we expect that if we have bad news, the lower and the price rapidly change. But at the same time, if we have a good news, the price is not rapidly change.
Yes.
Because again, the bad news is disseminated easily and faster than the good news. And you can check this in the neighbor things. Okay, just disseminate good news to try, and ask the last neighbor also. Okay, what things, and disseminate the bad news and see things. It's easily. Okay. Now, against of this is the last of this. I decided the last. Please, calm down. Active versus passive management. Active versus passive management. In facing this, the active managers, they don't believe the market is efficient. This is the last minute. But in the passive management, they believe the market is not efficient. And because the market is not efficient, they rebalance their portfolio. The active managers think, yes, the market is efficient. Then they don't need to rebalance their portfolios. They follow a techniques buy and hold. Okay? And in the passive management, they don't believe the market is efficient. In this way, the passive management believe the market is efficient and they don't need to rebalance their portfolio. The active managers, they believe the market is not efficient and they keep rebalancing their portfolio. The passive managers follows the buy and hold, and they are not rebalancing their portfolio. They keep stocks as it is because they think the market is efficient and they don't need to rebalance the portfolio. And you can read the rest of this. I think we finished. Okay. Next time, chapter 4. See you in